So hi everyone, I'm Diandra from Group 5, and today I'll be talking about my weekly report regarding the Bank Indonesia Holds rate as it focuses on debt purchases. First, let me start with the terminologies that I learned after reading the article. So there's reverse repurchase rate, basis points, contraction, global funds, and purchasing power. So what exactly happened in this article, right? On October 13th, 2020, Bank Indonesia capped its 7-day reverse repurchase rate at 4%. This is shown by the graph on your left and denoted by the red circle around it. Basically, during this period, they purchased bonds directly from the government to assist the funding of stimulus measures and has also alleviated banks' liquidity rules and reserve ratio requirements. This purchasing of direct bond is a one-off policy from them this year. Bank Indonesia will also then act as a stand buyer in debt auctions. To this day, they have bought 229.68 trillion rupiah, which is equivalent to $15.6 billion in government securities. Amid the inflation, the possibility for further rate cuts is still foreseeable as the central bank is expecting the inflation to be within the range of 2% to 4%. They're also predicting a 50 basis points of rate cuts after the US election, considering the fact that the economic recovery doesn't match up with the expectations from the policymakers. Why did it happen, right? This happened because Bank Indonesia was trying to help boost the economy as it is set for another contraction since the Asian financial crisis and because of the coronavirus pandemic. It is also done to maintain the external stability in the midst of inflation that are predicted to remain low. The data has been showing how rupiah has weakened to 0.2%, making it 14,725 a dollar. It is regarded as Asia's 2020 worst performer, and because of this poor performance, Global Funds has retracted approximately $10 billion of its investment from local stocks and bonds. So then, what are the potential impacts of the event? So the event may trigger the economy as interest rates directly impact consumer behavior and the level of consumption. These low interest rates encourage borrowing and investing, though excessive growth and subsequent inflation might also be the repercussions when the rates are too low, resulting in reduced purchasing power as well as weaken the sustainability of the economic expansion. And last but not least, what's my opinion regarding this matter? I believe that cutting down the interest rate is a good move from the federal as long as they know how to get into that equilibrium state. It is fundamental to know that excessive growth doesn't translate into a progressive outcome, as when there's too much growth, purchasing power will be reduced as well as the emergence of unsustainable economic expansion. Aside from that, I also think that central bank needs to know when to raise the interest rates back in order to facilitate slow inflation and assist the growth to be sustainable. So that's basically it for my presentation. Thank you so much for listening, and these are all the references that I used.